Okay. So like I said, today is day one of homeownership, and homeownership is going to be the largest single purchase you have to make. Every time you make a home purchase, it's your largest purchase you're going to make. The first time you do it is the most significant, okay? But in terms of dollar value wise, there is not a larger purchase than a home, okay? So with a home, purchasing a home, financing a home, there's some key terms we have to look at. And the biggest one is called mortgage, okay? Mortgage is the official name for a loan for a home or real estate. Real estate. So anything land related, they call it mortgage. So if you hear someone saying, oh, I'm having trouble with my mortgage, it means they're having trouble paying their home loan. Okay. So mortgage is the fancy word for home loan. All right. Now, with that said, there are two types of mortgages. Oh, I can spell, I swear. There are two types of mortgages. Okay. First type is called a fixed rate mortgage. Okay, a fixed rate mortgage. Okay, and a fixed rate mortgage is, kind of exactly what it sounds like. The interest and payment stay the same for the entire loan. Okay, makes sense. Fixed mortgage. The payments are fixed. Now, how the payment gets applied to the loan can vary behind the scenes, but the dollar value you're going to pay is fixed, is what they mean. So if they tell you you're going to pay a $1,500 mortgage payment, it's going to be that same $1,500 through the whole life of the loan. But what happens, remember we talked about this, when you make your payments, right? Part of it goes towards interest, part of it goes towards the actual paying off of the loan, right? Well, what happens with a fixed loan is for the first many payments, it's all going towards paying interest, or a large chunk of it's going towards paying interest, and only a little bit pays towards the loan, which is why, remember, I talked to you about if you can afford it, pay some extra. So if they tell you the mortgage payment is $1,450, but you can afford $1,600, then you want to be paying that $1,600. So the extra pays the loan off faster, so you owe them less interest. What happens is over the time period, it might start with a lot towards interest and only a little bit towards loan. But as you start paying the loan down, the interest is cheaper, so more goes towards the loan. And the interest gets cheaper because you're paying things off, so more goes towards the loan, okay? So it starts high paying off interest and ends high paying off mortgage. Yeah, monthly payments, yeah, monthly payments. You always pay monthly, okay? So a lot of good advice that a lot of people get and do is you pay an extra month, or you pay an extra, like you take that month, say, like I said, it was $1,450 a month, but you can afford $1,600, pay the $1,600, because how much difference is it between $1,600 and $1,450? How much extra is that? No, 1,600, 1,450, not 2,000. 1,600, 1,450. How much difference? Use your calculator. How much difference is that? Maria, where are you? $150. But if you multiply that by 12 months, how much extra did you make sure you paid off on your loan in that year? But if we multiply that by 12 months, that extra, how much extra did we pay off in a year? Over a mortgage payment. But it's only $150 a month. So most people, it's like, oh, that's not a big deal. I can do an extra $150 a month, right? But it adds up. So that pays basically more than a mortgage payment. So what happens is you've just paid extra to pay off the loan. So the amount they charge you for what's left of your loan is smaller, faster, saving you money. Okay. That extra loan payment thing a year, I think they calculated it and it's a 5-year that takes 5 years off the loan. So that's 5 years less of interest you pay them, which is a lot of money. Okay. Okay. So that was fixed rate. Okay. The other kind is the adjustable. Adjustable rate mortgage, which they abbreviate ARM. Okay. Adjustable rate mortgage, exactly how it sounds. Okay. The interest rate is adjusted up or down to match the market rate at specific time intervals in a year. Okay. Okay. Most common is every 6 months or once per year. Okay. Those are the two most common ones. Every 6 months or once per year. Those are two different things. Okay. So you could have one that adjusts every 6 months, or you could have one that adjusts once a year. Not very common. Do they have it adjusting more than twice in a year? Not very, not very common. Do they let you go more than 1 year before fixing it? Because remember, we talked about it before. Because of inflation and things like that, the interest rate that the banks get charged fluctuates. Okay. The interest rate fluctuates, and that's going to fluctuate how much money they're making off your loan. So they would prefer not to leave it fixed, because then in the years where the interest rate is going up for them, so they have to pay more, they want you to help pay your share of the more. Okay. There are some more details about the adjustable rate I want to give you, and then we'll have a little conversation about adjustable rates. Okay. This change in interest rate will change the payment amount also. So no longer do you have that $1,450 flat whole life of your loan. This year it might be $1,450. If you're a 1-year changer, next year it could be $1,500 or $1,400. So it can go either direction. Okay. Less frequently down, most frequently up, but they're charging you extra. Okay. All right. So people choose ARM loans, mortgage ARM loans, yeah, because the starting rate is lower than for a fixed rate loan, making the starting payments lower and more affordable. Okay. So sometimes it's a good plan to do a adjustable rate mortgage. Okay. So that maybe it's at a more affordable payment for you at this stage of your life. Again, like I said with the other one, pay the extra. If your current adjustable mortgage payment is $1,450, go ahead and pay that $1,600 if you can afford it. Okay? Pay the extra, again, to save you money on the interest. Usually, the lower rate is fixed for the first 3 to 5 years of the loan. Okay? Before the first adjustment happens. Okay? And then it'll be on the schedule that you've arranged every 6 months or once a year. Like I said, those are the two most common. Okay. People also choose ARM loans because they believe the interest rates will be going down after the first 3 to 5 years. Okay. So they're betting that inflation will make it so the interest rates go down. So that when their first adjustment happens, the payment gets cheaper. But then, of course, the smart move is to keep paying the one you're used to. So you pay extra. Okay. Okay. Now, one last thing. They are also picked by people who only plan to stay in the home for 3 to 5 years. Okay. Oops. Before moving, before they move. Okay. This is because they might be transferred for work frequently. So there are jobs, frequently, I can spell. There are jobs where the person's job is to go somewhere help get that location organized and under control, which might take a 3 to 5 year period. Once that one's under control, okay, now you're going to move to another one. Okay, there are jobs that are like that, where you have to move around a lot. So you do the adjustable rate mortgage because it's less interest to start and the payments are lower for that first 3 to 5 years that you know you're going to live there. And you're going to be moving on anyway before the adjustment happens. Okay. Okay. Backing up twice. All right. So there are these things called subprime mortgages. Subprime mortgages are given to those with not good credit to help them. Oops, I forgot the word help. Rebuild their credit. But they have a much higher interest rate. So it's not like the people who have problems can't, where did my margin go? Done it. Can't like rebuild and still own a home. It's just that they're going to charge you extra for that. We talked about that. It looks like it lets me do subprime that way. Okay. You've proven untrustworthy, but I see your life changes happened and things are back under control and stuff. So I'm willing to lend you money, but to still make me nervous, is what the banks are saying. We'll lend you money, but you make us nervous. So in order to have that benefit, we're going to have to charge you a little extra interest. Okay. Okay. Things to talk about subprime now. Danger. Danger, danger for weapons. This can encourage those with bad credit to borrow more than they can afford. And so they get into more trouble. Really and truly, the more humane thing to do for the bank, instead of giving them, hey, we'll charge you a higher interest rate. No, I think you need to go ahead and work on your credit situation a little longer. Go ahead and rent for a little longer. Those kind of things would be a more humane thing for the banks to do. But we all know banks are in it for the money. Everybody's in it for the money. So they don't want to turn away an opportunity to get extra money, which is, in my personal opinion, not very ethical, but it's legal. Do you guys understand the difference between ethical and legal? Sometimes it's the right thing isn't necessarily the legal thing. Sometimes the legal thing's not the right thing. Okay, so another thing about it, this type of loan is what caused the big bank crisis and was a major component to the recession in mid 2000s. Okay. A lot of banks were loaning money to people who really had no business getting a loan. On top of it, they would let someone come in and claim that oh yeah, I have a job where I make $4,000 a month, and my wife has a job that she makes $6,000 a month, and they didn't make them prove it because they were greedy and they wanted the money. The home prices were really expensive and they were greedy. So then they lent a lot of money to people who had no business borrowing money, they didn't even come close to having the kind of money they were claiming they had. And the people borrowed the money and got these big houses and made themselves feel great for a little bit, but then they couldn't pay for it. And things got really bad. And so all of a sudden, foreclosure, because these people do not have the money. Remember, foreclosure is when they take back the house. We talked about repossession Tuesday. Lots and lots of repossessions. Banks all of a sudden owned a lot of real estate because that's what happens when they foreclose the house. They own that real estate. Well, then all of a sudden, all these foreclosures are happening and the real estate market went boom. So now the banks have this real estate that they can't sell because there's no people out there to borrow. And it just made this huge chain reaction. And if you go back and look, I think it was 2005, 2006, there were schools that had to lay off hundreds of teachers because all of a sudden there's no money coming from the state because all these banks had to be bailed out. It was crazy. It was crazy. And remember, we looked at the GDP, the gross domestic product, and we went back and looked, and there was a year where it dropped from one year to the next. That was then. It was craziness. Okay. And it was because greedy. It is. I mean, the banks did it for themselves, but the average person had to bail the banks out because the government gave the banks money to bail out, and who pays for the government's bills? Everybody else. So there's my commentary on the whole thing. It's wrong. Okay, back to mortgages. Okay, mortgages are usually 15-year or 30-year. That's the two types. Okay. And like I already told you, here's my capital letter thing. Always pay more than the required payment if you can. So you pay the loan off sooner and save money on the interest. Do not give them more money than they really need to have. They already are greedy enough. They already are greedy enough. Okay. Now we talked about mortgages, but there's more involved than just mortgages in this whole purchase of this great big thing called house. Okay. And we're going to start some of those extra things. Okay. First thing is, oops, I had the cap on, I'm sorry. Other costs of buying a home. Like I said, there's more to it. Oops. I'm going to do a page break right here. So remember, we go up here, we do insert, page break. Okay. No, we don't want that turned on. That's my handwritten camera. Okay. Is my thing showing again? I'm back to showing my set of notes. Do you guys see my notes? Or do you see something else? Okay, good. Because it accidentally clicked on something and something else popped up, and I wasn't sure if you had seen that. Okay, so other costs of buying home. There are things called an appraisal fee. This is a fee paid to a person to check out the home and give a fair value of the property. Okay. Banks usually do not loan more than 80% of this value. So you may need a bigger down payment. And we talked about down payment Tuesday. Who remembers what we mean by down payment? Who remembers what we mean about down payment? Talked about Tuesday. Yeah, it's the money they expect you to pay them up front, the upfront money. So, example, you have saved $15,000. You see a house you want to buy. Okay. You go and look, and it's on the market for, say, 200,000. Okay. But sometimes people list their homes for more than they're really worth, because we all have an overinflated idea of how much our stuff is valuable, right? So that's why you have an appraiser go. That's why you have that done. Banks have that done, and usually the guy purchasing the house has to pay for that fee. Okay. They'll put it on the loan documents, and you don't necessarily pay that appraiser directly. The bank pays the appraiser, but you pay the fee in the long run. Okay. And it's the appraiser goes, and maybe the appraiser finds out, yeah, it is really worth 215,000. Or maybe the appraiser finds out, oh, it's really only worth 200,000, but he has it listed for 215. Good news about that is you can then go back and negotiate. It's part of that whole process of when you are looking to go buy a home, and that fine-tuned negotiation between you who wants to buy it and them who wants to sell it. Okay. But keep in mind, when the appraisal number comes back, the bank's not going to loan you more than 80% of that value. So say it comes back at 200,000. What's 80% of 200,000? That would be 200,000 times 0.8, right? What is 80% of 200,000? $160,000. You have 10,000. Is that going to work? If they're only going to loan you 160,000, nope. So you have to find a way to come up with more down payment. Is that, got it? Okay. Another thing, home inspection fee. Okay. Home inspection fee, okay, is fee paid to a person to come and check, ooh, that's not the word, and check that the home meets all building codes. Okay, so there are rules for how a house has to be built, building codes, safety rules and things like that, that you have to have this kind of wiring, that you have to have this kind of plumbing, that kind of stuff. And sometimes, especially with the older homes now, homes made before like the year 2000, older homes, they might not meet the new building code. So what happens is the person who owns that home might have to have some stuff fixed before they could sell that home because it doesn't meet building codes. Okay. Okay. Mortgage origination fee. Fee paid to the bank to offset the legal costs to set up the loan. So there's legal paperwork that has to happen when you buy a home because this is a huge purchase. And so they have attorneys on staff kind of thing. And those attorneys are not cheap because attorneys are never cheap, right? So what they do is each loan pays a little part of that attorney's overall fee that they charge the bank. Okay, loan application fee. Okay, it is what it sounds like. It's a fee to apply for the loan. Ooh, that's not the word loan. Okay. Filing fees. How many people are going, holy crud, how many extra stuff are they going to charge you for? Yep, there's still about 4 more. Filing fees. Filing fees are fees paid to the court for legal documents to be filed okay. So like I said, it's a legal document when you sign a loan, okay, especially for a house, okay. So you have all this legal paperwork. They then have to take it to the court and have it filed in the public record to show that you now own that home, but that the bank really owns it too. Okay, it goes in there, it gets filed that yes, you have a loan for the home. Yes, you have a legal right to that property, but there's a what they call a lien against the home, a lien against the home, which means you can't just go sell it and pocket the money and not pay the bank back. Okay, so the court charges for those documents. The bank brings them, the court charges the bank makes you pay for it. Okay, title fees. Title fees is a fee paid to a title company to make sure that no one else has a legal right, legal right to the property. Okay. And this is all or part. So this is a company that goes and does a public record search to make sure there's none of these other mortgages or legal documents out there that say the person that's selling you the home doesn't have the legal right to sell it to you, or that there's somebody else that owns part of it. So you have to negotiate with the both of them. You can't just be negotiating with this one person. Okay. So it's a protection for you to make sure that who is selling you the home actually has the right to sell you the home. And there's nobody else that has to get paid first. Okay. Oh, good. We're on our last one, and then we have 2 more sentences and we're done. Points. Yes, that is a fee. It's called points. Points are money paid in advance to pay down the interest rate. Usually $1,000 per 1%. Oh, no, per 0.25%. So, you happen to have this extra money laying around and the interest rate is at 6%. And you have an extra $3,000 or $4,000 sitting around and you don't want to pay 6%. You want to pay 5%. So you would pay them money up front to give you a loan at a lower rate. So like you're prepaying them interest is basically what you're doing with it. Okay, so these fees get tacked onto the loan and get spread out over the life of your loan. Or there are times when, depending on your credit, the bank makes you pay all these fees up front plus the down payment. Okay? Plus the down payment. And we're talking, these aren't cheap. When they add up, they're thousands of dollars once you add all the fees up. So they could say, we want 10% down plus all the fees. So it could end up being 15 or 25,000 once all of everything's pulled together. So that's why when you're looking at these loans and stuff, you want to shop around. Never take the one loan. Check with your bank. Check with your credit union. Credit unions are always a better deal than a bank. Okay. So, and we'll be talking about the difference between credit unions and stuff when we get into the banking section. We will. But you want to do your shopping around and do your legwork before making an offer on the home. Go get pre-approved so you know how much you can offer, how much the bank's going to want. The bank will give you an estimate on fees that they're expecting and stuff. You can get this all done ahead of time to make the purchasing the home a smoother thing because it's already crazy. Okay. All of these together, these fees together are called closing costs. Are called closing costs. Okay. And usually are thousands of dollars. Okay. And this is what we just talked about. Some lenders will finance them, which is make them part of the loan. Some lenders will make you pay them plus your down payment. Okay. Questions? Okay, turn this in, please. Make sure you turn in the Cami and the Google Classroom. Hit turn in for both. I have a couple private messages out there that need to be answered, please. Okay, let me stop share. We don't need to record that.